Hey guys, hope you are all having a fantastic morning. We have finally made it to Friday, and to the end of this 3-video series. Today we are going to wrap everything up. The first episode covered the ways by which individuals, families and small business were affected by the pandemic and the policies that were implemented to rescue an economy on the verge of disaster. Yesterday we talked about why it is that Wall Street has benefited so much by the pandemic. We looked at the stock and bond market, and discussed how policymakers made it impossible for competition to arise, making the wealth be fully concentrated among a very small number of corporations and Wall Street. We talked how the bond market in particular is using the Fed to infinitely print them money, isolating the gains from abusive practices that should have never been placed without oversight. To conclude the series, today we will talk about why and how none of the profits made by Wall Street trickled down to the rest of the economy. With precision, I will point out the greatest flaws in the system that prevented anyone from being able to enjoy much of the benefits that were supposed to be given back to them through the taxes they paid. I want to thank Amanda Fisher, whose work and due diligence has inspired me to make this video. Before we start, let me quickly state that I am not a financial advisor, and that all content discussed in this channel is simply information gathered that I deem important for people to know, so that they can make informed decisions. All efforts are aimed to better understand the nature of the current market in anticipation of the greatest squeeze in financial history. Let's get started. So, picking up directly from where we left off, we know that the stock market and the bond market made an absolute killing. The question then follows, how are individuals, families or small businesses benefiting from stocks and bonds? Are stocks preventing layoffs or boosting individuals' investment incomes? Are they bringing in customers to small businesses, or helping state and local governments with declining revenues? Let's address each of these questions directly. Financial market gains are not preventing layoffs. Only 17% of workers are employed at an S&P 500 corporation, which pales in comparison to small businesses, who employ nearly half of all the workforce. Most businesses don't issue stock either. You would think that companies that issue shares and see positive growth would feel confident innovating or investing in workers, but that is simply not the reality. In fact, investors penalize companies for investing in workers. American Airlines was downgraded by analysts for giving its pilots and flight attendants raises. The famous Chipotle Mexican Grill experienced a stock decline once analysts determined they could not reduce its workforce costs. Big tech companies don't employ that many people in comparison to their share of stock market's total value. While the small number of firms represent 1/4 of the market capitalization, they only represent 5% of the workforce in the S&P 500. They are also more likely to use gig workers and independent contractors, who do not enjoy job security. Uber and Amazon use independent contractors because it is a cheaper alternative than employing people. Google and Facebook use them too to screen their platforms for inappropriate content. The unique position that was brought about by the pandemic caused a huge surge in the tech sector, but much of its growth has to also be attributed to the outgrowth of antitrust policies that allowed prolific mergers and acquisitions like the ones we talked about yesterday. Let's talk about the Fed. I must ask that you guys try to digest what I am about to say in the most fashionable possible way you can. Learning some of this stuff is really going to frustrate many of you. The Fed's bond support could have hypothetically supported workers at any companies that had issues with debt. Boosting companies on the verge of bankruptcy or default on payments was way better than having to deal with a company that had already gone bankrupt and laid off all its workers. Through the CARES Act, discretionary authority for the Fed to rescue companies in order to retain jobs, maintain agreements, prohibit dividend and stock buybacks and limit executive compensation. This made total sense, but the Fed starting looking, manufacturing and using legal loopholes to sidestep these conditions imposed by the CARES Act. A great example of this is when ExxonMobil issued a ton of bonds, which the Fed purchased. While ExxonMobil did this, they were also preparing to start cutting jobs and ending their employer match for their remaining employees' 401k retirement plans. There are tons of stories of companies being allowed to issue bonds, which the Fed used, and then they were allowed to fire millions of workers anyways, which meant that all the money that they raised from issuing those bonds still went back to the executives and to buy back their own stock, which is why many of these companies had great stock market performances right after the pandemic. They literally got the Feds to print them money they used to buy their own shares and pump their stock. As for the workers and families that were left stranded, nobody really cared as the main media was too focused talking about how great the economy was since the stock market has been doing so well. The next point I brought up was regarding the potential boost to investment incomes. Well, To the surprise of no one, things do not fare better here. Though half of Americans are invested in some stock, either directly through a retirement plan or not, most of the value of all stocks are heavily concentrated. In fact, the top 1% of households own more than half the value of all outstanding shares. Corporate bonds for individuals are very limited in the United States, which makes it very unlikely for Americans to experience any substantial income from investing in bonds too. Going back to stocks, I had made a video talking about how one of the ways by which the rich get richer is by continuously rising the prices for everything, making it less accessible for others to attain. As such, good stock investment income becomes harder for middle and lower class to attain. They literally rigged the game for themselves so that nobody can have access to the pool of wealth. The next point into figuring out if profits from Wall Street are trickling down is to see if small businesses have seen growth in revenue or traffic. Well, the Fed's action is doing little to nothing for small businesses. Small businesses don't issue stocks or bonds, so much of the intervention the Fed could potentially do goes right out of the window right there. Low rates should theoretically allow small firms to borrow cheaply from banks, but bank lending is retrenching as financial institutions continue to become more risk-averse during the pandemic. The Fed had initially created a separate program to facilitate direct lending to small to medium-sized businesses, a program known as Main Street Lending Facility. However, despite the $600 billion available for funding, the Fed only committed to $252 million across a little over 30 loans in total. As you can see, the Fed's sluggish program was made with the intention of not really helping any small businesses, because what better way to take out Wall Street's competition than leveraging the pandemic restrictions and use it against business owners? The Fed is an absolutely disgusting institution that not only should be held accountable for the way they have operated, but should also be broken apart and put out of its misery. No, I do understand that the Fed has a vital role in our economy, and for that I think we should replace it with a newer institution that works in a more appropriate manner, and one that can be more easily held accountable. Jerome Powell is an absolute genius in much of what he manufactured these last 2 years, and he is the scum of the earth for doing so. The recession and policy response produced an inadequate response from the Fed that ultimately allowed for the crippling of most small businesses. Many have gone bankrupt, and many are on the way to close shop forever, all because Wall Street must be favored above all else. Last point was whether local and state governments were helped with their declining revenues. There has been a very apparent lack of emergency support for state and local governments bearing the increased costs of fighting the pandemic. Public sector job losses and services were cut for a long while, which handicapped the economic rebound that should have happened. This was once again brought by the Fed and some of the impositions that they forced. Their requirements were so much more stringent on municipal borrowers than the corporate ones. Data shows that by mid-August of last year alone, over 6% of the workforce in states and localities were cut. The answer is a huge resounding no for this one too. The idea that trickle-down economics work is just that, an idea that has been allowed to propagate for too long. The success of Wall Street because of the pandemic did not trickle down to individuals or families, nor did it trickle down to small businesses. The CARES Act allowed the Fed to use their own discretion in enforcing balance, and the Fed made sure to use all its power to make sure that only the rich and Wall Street saw green balance sheets. Congress failed to provide the needed support, and now we have an eviction crisis, a health crisis, an addiction crisis, child abuse, and a huge list of other problems that we must as a society pay the cost. Meanwhile, Wall Street has continued to stabilize their profits, and are setting high benchmarks for years to come. They continue to recover faster than ever imagined while many continue to live in fear of getting their hours cut or being fired. Policymakers have sure demonstrated that being blind to all systemic problems in a country is a requirement to hold public office. However, something changed last year. A stock was discovered and millions have rallied around it among some other stocks. These meme stocks, as they would eventually were labeled, have become the best hope we have. They will work as a reset to rebalance a lot of the wealth that has been pooled in isolation for the 1%. Though nothing about this video was positive, I do take comfort that every meme stock I own is a ticket for generational wealth. This will be the greatest wealth redistribution we have ever seen in history, and I will continue to add until we rocket off this God-forsaken earth. And with this last ray of hope I have imposed onto you, this is where we end the 3 video series. I hope to have added value, information, education and understanding about how Wall Street got to prosper so much through the pandemic while the economy continues to decay. Now that you guys have such a profound understanding of how exactly it is that we got here, I must ask you one favor. Let me know in the comments below what you thought of the video. If you want to go a step above that, feel free to like the video so that it gets pushed to others to see. I will leave you guys be for now until we meet this afternoon after the markets close. I hope to have inspired a wrinkle here and there. I want to thank Amanda Fisher one last time for her incredible work, who I greatly borrowed and used. She serves as hope that there are still good journalists out there. And again, thank you all so much for making it to the end of this video. If you want to support the channel, I have left links in the description for my Patreon if you would like to pledge a monthly support of any amount you want. I also left a PayPal and Cash App link if you want to make a one-time donation. Good luck on the rest of your day and to the moon.